In a follow up to last Monday's Breakfast Club, I'm going to take you back to a little stock called MaxLinear, stock symbol MXL, and show you how this stock tripled in just 10 days. And in a fun and shocking turn of events, how options dealers got run over by the market bus like an American tourist looking the wrong way in London, and how the entire financial media missed what actually happened with MaxLinear. And this is still going on. MaxLinear, for our purposes, this stock that we've held since February in the AI2 portfolio, currently up over 220%. And with an up-day pre-market, we'll see how the day actually transpires. But we will walk through the sequence of events last week as an instructive way to understand the confluence between fundamental, technical, and options analysis, and how it can help you to see things that normally you don't just see just looking at a daily chart or a weekly chart. I will also take a look at the explosive gains in the AI2 portfolio since February, and take a look inside Income Masters, how we performed last week there. This is Breakfast Club. I'm John Hutchinson. It's Monday, April 27th. Welcome. I hope you're having a good day so far. Let's get down to our story for today. Again, coming back to MaxLinear, which I spent time on last week, talking about how there was a major squeeze taking place, that options dealers had run out of strikes as of last Monday. And that entire situation persisted throughout last week, leading into the earnings report on Thursday for MaxLinear after the market closed. And the stock then gapped up and closed really a shocking 76% one-day gain. That's not a typo, and I did not misspeak. A 76% one-day gain. You can see it on the chart. And still up in the after hours as of Friday as well, up pre-market again today. But a little bit of a notation here. You can see this $20 level acting as resistance for an extended period of time. And we'd been in this stock since early February, mid-February, excuse me, around the $19 level. And this stretch right here on the chart that I'm drawing out is what was called a gamma squeeze. And what happened there, to keep it simple, if in case you weren't with me last Monday, is that dealers ran out of strikes to sell in the options market. And what that meant was they had no way to hedge the current options strikes that were available. Now, MaxLinear trades monthly strikes only, and currently only has 4 expirations available for the calendar year: May, June, September, and December. Excuse me. So there was essentially a 3-part move here. These 3 candlesticks that I'm highlighting that precipitated the massive gamma squeeze that took place early last week. But that squeeze continued into earnings. And you can see the stock opening up here at 54, closing over 60, as dealers had no option strikes in that box that I'm drawing on the chart. None, and none above either. So let's take a look at how that transpired. And more importantly, nobody told you this happened. Nobody, except me. I guess I was the only one. Every single financial media outlet focused on the earnings, which were far and away spectacular, but not one of them shared with the investing community the fact that options dealers they lost their shirts last week. Now they'll make it back. Please don't cry for the options dealers ever. But more importantly, the over-reliance. This is a partial negative to artificial intelligence. Many of these companies use artificial intelligence to to automate the process of writing about earnings reports. Zacks does it regularly. Motley Fool uses it to a degree. Other outlets leverage artificial intelligence. Well, this is a shortcoming of artificial intelligence. It cannot see past a singular point of instruction, so to speak. So, for example, an article comes out and says, "Tell me what happened with MaxLinear's earnings." It Artificial intelligence doesn't know to look at the options market and see what happened. But because we owned the stock in our AI2 portfolio, and because I've been following MaxLinear's rise over a series of days, not only did we see it as it happened, we watched as it unfolded across the full week last week, and it is still unfolding today, and it will continue to unfold in and around the next 2 weeks, because the next expiration is May 15th. So options dealers still have 3 weeks of pain. But to put this in a little different perspective, let's walk backward and then come forward. When we first entered this stock back in mid-February, the stock was trading between 19 and 20. We kind of caught it on the high side in advance of the Iran war conflict, whatever you want to call it. So at that point in time, the stock was trading around $19.45 when we added it. And they are in the optical digital signal processing market, which right now, across the entire optical sector within artificial intelligence, almost every company that I have researched has had a substantial run over the last 3.5 weeks. Companies like Corning, Lumentum, Ciena, and many others, they have had significant runs since the April 7, 8 ceasefire was announced between U.S. and Iran. And then last week, 2 weeks ago, excuse me, the stock had run up a little bit to about $23 a share. At its low point, however, in the weeks prior, during all the sell-off taking place across Wall Street, with oil up and Iran and bombs and et cetera, the stock was down to around $16. So we were actually sitting on a fairly sizable negative position. I think the low point was about minus 23%. So we had to wait that out, and we did, because the fundamentals stressed to me that the stock was still worth holding, even though it was in the red, like many of the positions in our portfolio were during the month of March. But this one came back blazingly fast. And at the end of the prior week, not last week, but the week prior, the stock closed at 34. Why? A couple of reasons. One, in advance of earnings, MaxLinear received a couple of important upgrades. One from Susquehanna Research, which raised the price target to $30, and the second from a company called Needham Capital, which is one of Wall Street's most conservative outlets. Needham raising the stock from a hold to a buy. That was an important trigger. That created a significant rush into the stock. If we go back on the chart, 2 slides, that was all of this move starting to push the price up toward 30. And then those upgrades came out. You can see the stock pushed all the way up to and through the $30 level. All of that was pre-earnings. There was no pre-earnings announcement. It was strictly related to the capital upgrades. And as the next week the end of that week into last week took place, those last big bars did this: 6% on Thursday, a 12.5% gain on Friday, and then the first gamma squeeze, Monday, April 20th, last Monday, when the dealers literally ran out of strikes, a 20% move last Monday. That was then followed by a little bit of basing Tuesday, Wednesday, Thursday, and then the 76% gap up on the Friday of last week. But what did they say? What did they say, and why did it matter? 2 things happened related to that earnings report that play back into the gamma realm, which we'll look at on the next slide. The first and foremost was, after MaxLinear reported earnings, the most important piece that came out of their earnings conference call were the words step function. That means that their revenue and their orders were accelerating at a pace that would increase their business almost at a 100% multiple. That was unexpected by Wall Street, and that led to after hours pricing rising from $34 to $48. Now that's just a 31% gain. So when the market would open the following morning, that was in line with the expected move, right? If you use Thinkorswim or many of the other platforms out there, right, you could see the expected move. That was in line with what the expected move was. It was roughly 28% one way or the other. Earnings being a binary event, right? Whatever the expected move is, it's always a plus or minus. But the expected move was about 28%. So that was in line. And at that point in time, as of Thursday, the top strike available on MaxLinear was $47, which was still in that range, probably would have been okay. But there was something else that took place over the period of time, which is that last Monday, I pointed out that dealers were running out of strikes. The top strikes for the May and forward expirations were either $30 or $35. There was nothing in the middle as of last Monday, and there was nothing higher than $35 last Monday either. So when MaxLinear's stock price bumped up into the low 30s, the options dealers were already in trouble last Monday. So the next day, Tuesday, the CBOE opened strikes to close those gaps. So they added strikes between 30 and 35, and then between 35 and 40. Well, that lasted one day. On Wednesday, the CBOE increased strikes available to 47. That took us into the earnings event. So that was the top strike. The difficulty the dealers had was they had no place to lay off risk. They had no place to lay off risk up or down with the significant squeeze and move that had already taken place in the stock, which forced them to buy stock. And that becomes a sort of a self-propelling function where the stock just keeps going up. Then on Friday, when the stock gapped up, remember, there were no strikes above 47. So the stock didn't open in the 40s, the stock opened at 54. And that forced dealers to have to continue to buy shares throughout the early stage of the day, pre-market and into the open. And that became sort of it's the opposite of a rock rolling downhill, right? It's an upsloping avalanche in price. And the reason for that is because two things. Number one, think of a call and a put. Every single call strike when the stock opened on Friday was deep in the money, right? The gap between the highest call strike and where the stock opened and ultimately closed was more than 20%. And every single put strike was deep out of the money. So between both of these, depending on how a trader was actually leveraged, whether they were a buyer or a seller, dealers were forced to either take short positions way out of the money, which would never be profitable, or buy stock, or do both. So that is what created the other half of the move on Friday. So the first 30+% would have been the earnings move. If there had not been a second or third order gamma squeeze here, which actually rolled down into delta, vega, and charm metrics as well. But if those additional squeezes hadn't occurred, the options availability had been normal, what you would have seen was the stock would have moved up maybe $9 or $10 instead of moving up nearly $30, $30 to $33 per share. But nevertheless, the key thing here is when companies that you own or follow, when they report earnings, sometimes it's worth looking beyond just the basic details, beyond just the basic headlines. And in my case, what I'm looking at is where are institutions positioning themselves in the options market. And what I could see with MaxLinear was the $20 strike was the heaviest, one of the heaviest and most traded strikes on the call side, which implied a long position, right? They expected the stock to go higher. And the secondaries were in the second element were the put strikes in around 28 to 30, right? Those would have been short puts, not long puts, because the stock wasn't trading above 30. But those then flipped out of the money, which meant the dealers were now obviously on the hook. And when you look at delta on pretty much every strike from right now, it's around 24 pre-market, 24 down. You're essentially trading at zero delta. That's number one. Number two, they've now opened strikes up to $90 for puts and calls, and they've backfilled from 47 to 90. That is a significant expansion of options availability in this stock. What it tells me is the move isn't over. This is not a singular event. And what I'll be watching and researching going forward is what changes in the options market over the next several days. This entire structure of a multiple or a multiplicative gamma squeeze will take 2 to 3 weeks, maybe longer, to play out because of the positioning of institutions at significantly lower strikes, especially on the call side. And to a degree on the put side. Now, the calls significantly outweigh the puts on MaxLinear. So that's the other thing I'll be watching is, does that change in the weeks going forward prior to their next earnings announcement, which would be in late July. So there you go. It was fun to watch. Remember, you don't get to see dealers lose their shirts often. So enjoy the moment, enjoy the story. Like I said, doesn't happen often. But it's why the idea behind methodology is really the most important thing. Anything that you can use to help you gain more insight to where the key levels are, especially in not just in the stock chart, but in the options market. And looking beyond just at the money, looking deep in the money for calls, looking deep out of the money on puts, and even on the short call or long put side, you can gain insight that can help you to see where institutions are positioning, and that positioning can give you a little bit of a tip. It's not a prediction. It may just simply be a projection, but a little bit of a tip that a stock has upward potential. So moving over to the AI2 portfolio briefly, we have 7 stocks that are due to report earnings this week into next, starting with Silicon Motion, Advanced Micro Devices, Coherent, Amprius, onsemi, Lumentum, and Kulik and Safa, KLIC. One of the things that I'm noticing is, or I have noticed, especially across the optical semiconductor, memory chip, semiconductor equipment and materials sector, which is about 80% of the AI supply chain, is all the stocks in these industries have all had multiple weeks of significant increases in price, going on 3 to 4 weeks for many of these stocks. All of that traces back to the ceasefire announcement. So in one sense, that makes sense. But the significant moves that have taken place over the last 4 weeks implies a new order of events taking shape in artificial intelligence build-out. The expectation for rising demand and backlog of orders, the limited supply or low supply, or even in many cases in the memory chip market, no supply. This is Wall Street rapidly repricing across a broad swath of companies for what they anticipate to be a multiplicative earnings event in future quarters, not just the current quarter. It doesn't mean stocks won't pull back. They will. There will be profit taking. That's normal. But right now, what Wall Street is seeing is an inflection or a step function in the order of magnitude of earnings and revenue in those core sectors. Again, semiconductors, memory, storage actually was another one, optical connectors and components, and semiconductor equipment and materials. So the AI2 portfolio has been actually well positioned across that. And you can sort of see what I'm talking about in the performance chart. And because we are largely aligned with optical semiconductor memory and semiconductor equipment and materials, the right hand of the chart here shows you since April 7, right here, this significant increase in the performance across what was a total of 15 stocks, which is now 13 stocks. We've taken profits on 2 companies and took a half position off on MaxLinear. But that's a significant increase in our overall performance that has taken place in just the last 3 weeks. So from a low point down here, all the way up, we've moved over 60 points in performance since the end of March. I don't think that's going to end anytime soon. We even realized over $2,700 in profit on trades taken off, and we're currently sitting on over roughly $18,000 to $19,000 in total capital return, unrealized paper gains here in the later stages of April. This week begins big tech earnings, this week and next especially. So that will give us, especially on the hyperscaler end, if we continue to hear either increases in capital expenditures or that the Microsoft, Amazon, Google, et cetera, are maintaining their capital expenditure forecasts, that will continue to imply strong growth, especially in the stocks that we're already holding and in other stocks that I'm looking to add to the AI2 portfolio in the coming week or weeks. With that, let's take a quick look at Income Masters last week, closed 3 trades. The one that I want to point out most importantly here, the SMH, which is in the semiconductor realm, has been on a significant run of multiple higher closes, something that is unprecedented in roughly the last 12 or 13 years, or has not happened in the last 12 to 13 years. So keep your eye on semiconductors. They are in a massive cycle change. And if you're looking for a stock to trade or own, start with semiconductors. It's hard to go wrong in that realm. But you can also see all of the closes were on the tech side as technology led last week. And one of my underlying thesis points right now is technology is in part Wall Street's hedge against higher oil prices and what's taking place with the ceasefire conflict in Iran, in part because the capital expenditure story hasn't changed. The growth story is accelerating. The earnings are positive and have been over the last several weeks. Last week was multiple drivers for the tech market included Texas Instruments, stock symbol TXN, and Intel, which I don't want to own, but stock symbol INTC, both reporting substantial increases in earnings, which positively impacted the entire range of the AI supply chain last week. So overall, a good week for closing out trades. And with that, tonight we'll be looking a little bit more deeply at MaxLinear and how we can use options ourselves inside of AI2. So we'll be taking a brief deep dive. I'm not going to spend as much time as I did this morning because really what we want to focus on is what happens from here forward, and that's what we'll be taking a look at. So for those of you who are in AI2, you have a lot to look forward to. So new positions are also on deck. Sorry, I made a mistake and clicked the wrong button, as I often do. Try to keep that there. So let me take a quick look. I've got a question from Anna. Great research, and thank you, Anna. I appreciate that. Possible to identify similar setups. I spent my whole weekend researching that exact question, Anna. And the answer is yes, it's possible. Um, in fact, I think we own one right now in Amprius. I don't know. I don't think it's going to do the same kind of 70% move that MaxLinear did. And the key difference is Amprius has weekly options, whereas MaxLinear does not. Number one. Number two, MaxLinear had actually had strikes taken off the board over time because the stock price had been depressed. It had been trading in a range between, well, I pointed it out, below $24 per share. So the options dealers, weren't getting any action above, say, $28 or $30. So they would just drop those strikes. When things changed, suddenly the options dealers needed those strikes, didn't have them. That created the gamma squeeze. So is it? But from a fundamental perspective, yes, I think it is possible. That was the full breadth of my research this weekend was where are stocks that are setting up that have a similar, where Wall Street is overlooking them, and they are positioned to profit or to increase revenue, increase earnings, increase orders and forward business. That was my weekend this weekend. So I do have a number of names, and I'm trying to scale them down. I still see the optical market as in a different, across a different group of stocks as one of our best plays for this quarter into next. But yeah, that is exactly where I'm going. In fact, one of the stocks we closed a little bit earlier this year, semiconductors, CEVA. Oh man, moved. I think we bought that one at 19 or 20. It's now up to 28. So there are stocks in the small cap realm that are starting to get attention. Another one to look at is Poet Technologies, stock symbol POET. They are pre-profitable. That means they have negative earnings. But somebody is excited about that company because it doubled last week from $8 to $15. Would not have been on my radar at $8. It's on my radar now at 15. So we'll take a look at stocks like that and more. So thanks for the question, Anna. Appreciate that. All right, I will have they collapsed. Poet now back down at 983. So that is true. So I'm looking at a weekly chart. Let me share it with you. Give me 1 second to switch. Here's the weekly chart. Yeah. So if you go to the daily chart, you can see alleged confidentiality. Oh, that's interesting. Disclosures has canceled, all citing confidentiality. So this whole move last week was based on exactly this headline. That Poet Technologies was the beneficiary of related purchases from Marvell Technologies. That was that whole move, and now they're giving it all back for whatever reason. So we'll just take Poet Technologies off the board. We won't waste our time with that. But as long as we're looking, we'll take a quick look at CEVA. There's the big move last week on CEVA. And that's not an earnings move either. That's a 17% move in 1 day, right? That's the daily chart. That is the daily chart. 17% move on the day, back up to a key resistance, a longer term resistance, right? We held it back in here from early January. Stock never got going, so we let it go. Of course, now it gets going. But looking better now, even on a weekly chart, you can see this 1, 2, 3, 4 consecutive weeks of up moves, but sitting at a resistance point now. So that was a stock that we had tried to trade. Didn't work for us the first time around. I think we either gained 1% or lost 1%. But anyway, so yes, those stocks do exist. They are out there, and we will continue to research and add them inside the AI too. You're welcome. Thank you. Look forward to, we'll see you at 4:00 then, Anna. And you'll be happy as soon as I finish the new database. I'll have an entirely new AI2 index with more functions to help you find the stocks that you want to trade. So thanks for letting me know that how you're using it, and that you're finding success finding trades on that. Excellent. Good to hear. Okay, that'll do it for us today. Let me stop the recording there, and I'll have the recording